Hello everyone, welcome to IFL Securities YouTube channel. We have with us Mr. Manish Gangwal, CFO President at Gulf Oil Lubricants India Limited. Welcome Manish, it's a pleasure to have you with us today.
Thank you for having me.
Yeah, so we've seen that Gulf Oil Lubricants Limited is a part of the Hinduja Group and the fastest growing player in the Indian lubricants industry. So Manish, we just have a few questions with you, like what should be the growth rate of the lubricant industry in the next 3 to 4 years?
See, in a normal situation, lubricant industry would grow 3 to 4%.
Okay.
Because there are a lot of long drain products which are being introduced in the market, which last longer. So technologically advanced products are being launched, and hence the volume growth is typically 3 to 4%.
Okay.
The retail market, what we call the bazaar market, usually grows a percentage higher than the overall lubricant market. But at Gulf Oil, we have grown always 3 to 4 as the market growth rate. So that has been our trajectory. Our CAGR volume growth rate over the last 10 years has been 10% plus.
Okay,
so
that's
we
great.
have grown double digit over the last 10 years or so.
Okay, that's really great, sir. And so also I would be asking you, like, what has been the key qualitative reasons because of which the company has outperformed the industry growth?
You see, we have followed a multi-pronged strategy. I would say we have 5 things. We are doing 5 things which are different, or I would say differently doing. Because first and foremost, we have been pioneering introducing the long drain products, which I just spoke about in the Indian market. So Gulf has been pioneer in introducing the long drain products, so technologically superior products, especially in the diesel engine oil and motorcycle segment.
Okay.
Second is, of course, our brand. We have been spending consistently 6 to 7% of our revenues back into brand over now over a decade or so. And our brand has now, I would say, very good recall. We are in top 3 most recalled brand in the lubricant space now.
Okay.
We have also done this innovatively. So we have been the first company in the lubricant space to tie up with an IPL franchise, for example.
Okay.
We have global tie-ups like McLaren in Formula One. We have been having football properties. So we have a cocktail of sports and racing heritage, which has given the brand leverage, and consistently doing it over a period has helped us gain the brand recall. That is the second thing. Our segment-wise approach, I would say, is the third thing, wherein we focus on a particular segment and we try to make a market share there, rather than focusing everywhere at the same time. We have chosen our battlefields, I would say, and try to focus there. And that has helped us. Fourth is our OEM relationships. We have today 20 plus OEMs in the automotive space, which are our partners, I would say. And we have nurtured them, we have grown together with them. And that has been one of the significant strengths, I would say, added over the last decade. Fifth, and this is last but not the least, is the passion of our team, our people, which has been relentlessly working on the ground to deliver this kind of market-leading growth.
Okay, that's great, sir. So also your current capacity in both your plants, that is around 1,40,000 KL. What are your plans to increase the capacity in the next 3 to 4 years, and how much capex would be required for the same?
So you're right. We have 1,40,000 KL capacity. In addition, we have 30,000 KL capacity for AdBlue manufacturing, which is a recent product line in the overall space. But I would say that this capacity is on 2-shift basis. So if we run our plant on 3rd shift also, we can produce more. Okay. So for the next 2-3 years, we do not see any major capex on the plant capacity expansion side. Maybe 15 to 20 crore rupees annually, which will be towards balancing equipment, some filling lines, etc. Okay. But not a major capex on the enhancement of the capacity for next 2-3 years.
Okay, that's great. Also, will the EBITDA margins decline in the next few quarters because of the increase in the raw material prices? And what measures are taken to maintain the EBITDA margins?
Yeah, this has been a significantly turbulent period last 1 year, I would say, when our base oil is our key raw material. This is a derivative of crude. Okay. While the crude was stagnant, if you see over the last 1 year, of course, the recent hike is a different thing altogether. But before that, crude was in a band of $70 to $80 for a long period of time.
Okay.
But base oil has more than doubled from the lows of September 20 quarter, I would say. So over the last 1 year, more than doubled some of the base oil categories. And that led us to increase the price in the market significantly. We have taken around 4 price increases over the last 1 year to pass on this cost impact to the end consumers and customers.
Okay.
And now I would say that the full impact of that has been realized. So our margin are in the same band. We usually give a guidance of around 14 to 70%, 17%, guidance for the EBITDA margins.
Okay. Okay.
And we are back in that range, I would say.
That's
Also, some impact is seen because the top line has grown significantly because of price increases, and as a percentage, the margins look lower. But on a relative basis, if we compare over from old realization, we are back in the band of 14 to 17%.
okay. That's nice, sir. Also, sir, post COVID, which business segments are showing good demand and which segments are lagging?
So I would say almost all the segments have fully recovered from COVID. Retail market, especially, which was impacted because of the lockdowns, etc., is now back in track, fully open. All our B2B customers, OEMs are operating fully.
Okay.
So from the market side, everything is open. We are seeing some slackness, I would say, in the demand from rural side over the last 1 quarter or so. So there is some slowness there in the rural side, but other than that, I think we are fully open.
Okay, that's good. Also, sir, how much % of your revenue has a threat from the electronic vehicles, and what are the steps taken to mitigate the EV impact?
Yeah, that's a very important question, and I would like to take some time out here to explain,
Sure.
because there is a lot of confusion around this also.
Mm-hmm.
You see, overall, the lubricant market, if we divide, it is around 40% of the market is in the diesel engine oil segment, 40 to 45% market, which is medium and heavy commercial vehicles largely, and some buses and tractors.
Okay.
Then we have around 20% of the market, which is the allied products like gear oil, greases, coolants, brake fluids.
Mm-hmm.
Around 20-25% of the market is industrial products. And then rest around 15-20% market is the personal mobility, which is cars and motorcycle, etc. So if you see within this spectrum, overall 80% of the market, which is your medium and heavy commercial vehicle space, the industrial space, the coolant and gear oil greases space, that market is not likely to be impacted from EVs in any significant manner. So 80% of the market is anyway, away from the lubricant, the EV perception. Now, balance 20% is, of course, there will be some impact as we move forward, and as there is a increased penetration of electric vehicle over a period of next 10 to 15 years. But within that also, we have to understand few more parameters. India is a under-penetrated country in terms of vehicle owned per capita. The vehicle as a ownership as a percentage of population is very low still as compared to many geographies. And we see that the vehicle demand is going to continue for the next 2-3 decades. And there will be in this incremental journey, there will be participation from EV, but the core lubricant market, and we have discussed this internally and with many experts also, the lubricant market in India is going to continue to grow for the next 10 to 15 years.
Okay.
And that is something which I would like to mention, that it is important to understand. In addition to this, in the electric vehicle space, the two-wheeler side, which is where we are seeing a lot of action happening, India sells today roughly 15 to 20 million new two-wheelers every year. And that at a CAGR of growth of 7 to 9% also would be roughly 25 million per annum sale.
Okay.
Now, even if there is a 20-30% conversion to EV 10 years or so, there will be a sizable population of non-electric IC-based two-wheelers also on the road and adding to the vehicle park. So we do not foresee any major impact of electric vehicle sector for next 10-15 years, and market of lubricant market in India should continue to grow. In addition, we are participating in the electric vehicle space through our acquisitions in some of the categories, and we want to build an ecosystem around electric vehicles. And e-fluids is another lubricant category which is launched by us, which will cater to the electric vehicle space as we move forward, and as there is a sizable population is there of electric vehicle on the ground. So just wanted to give this perspective that
Okay.
the impact overall is not going to be any meaningful impact over the next 10 to 15 years on lubricant.
Okay, sir. Thank you for this great insights on it. Also, sir, with respect to the ongoing Russian-Ukraine crisis and all, so how do you see, the impact on your business and the rising crude prices?
So we do not have any direct import or export to these geographies,
Okay.
but overall, as we have seen that crude has taken a significant increase ever since this crisis has started, and our base oil, which is the key raw material, is a derivative of crude, but with a time lag of 1 to 2 months. So whenever there is a sharp rise in crude oil and that is sustained over a period of time, if it is a very one-off and short duration increase, then the impact may not be much. But if there is a sustained increase in this crude oil pricing level, then we may see some impact on the base oil after a lag effect, and then we have to again go for our price margin management strategy, and we have to take pricing action to pass on those increase to the end consumers and customers, which we and industry has been able to do fairly over the last every time whenever there is a situation like this, we have been able to successfully pass on the cost impact to the customers.
Okay, that's great. And this is quite insightful, Manish. Thank you for giving these all insights onto our viewers and everyone. And thank you for this session, Manish.
Thank you for having me.